Factoring. Factoring is defined as an outright purchase of credit approved accounts receivable with the factor assuming bad debt losses. The modern factoring involves a continuing arrangement under which a financing institution assumes the credit control or protection and collection functions for its client, purchases his receivables as they arise, maintains the sales ledger, attends the other bookkeeping duties, relates to such accounts receivable, and performs other auxiliary functions. Basically, factoring is an asset-based method of financing as well as specialized service being the purchase of book debts of a company by the factor, thus realizing the capital tied up in accounts receivable and providing financial accommodation to the company. Types of factoring. In factoring, there are several types. So, the first type will be recourse factoring. In this type of arrangement, the financial institution can resort to the firm when the debts are not recoverable. So, the credit risk associated with the trade debts are not assumed by the factor. On the other hand, there is a non-recourse factoring, the next type. In this, the factor cannot recourse to the firm in case the debt turn out to be irrecoverable. The next will be disclosed factoring. The factoring in which the factor's name is indicated in the invoice by the supplier of the goods or services asking the purchaser to pay the factor is called disclosed factoring. What is undisclosed factoring? The next type. The form of factoring in which the name of the factor is not mentioned in the invoice issued by the manufacturer. In such a case, the factor maintains sales ledger of the client and the debt is realized in the name of the firm. However, the control is in the hands of the factor. The next type of factoring will be domestic. When the three parties to factoring, that is customer, client and factor, reside in the same country, then this is called as domestic factoring. Next type, export factoring or otherwise known as cross-border factoring. It is one in which there are four parties involved, that is exporter, who means as client, the importer, who is also a customer, export factor and import factor. This is also termed as a two-factor system. The next type will be advance factoring. In advance factoring, the factor gives an advance to the client against the uncollected receivables. Maturity factoring. The factoring agency does not provide any advance to the firm. Instead, the bank collects the sum from the customer and pays to the firm, either on the date or with the amount is collected from the customers on a guaranteed payment date. Modus operandi of financing. A factor provides financing to his client up to a certain percentage of the unpaid invoices, which represent the sale of goods or services to approved customers. The modus operandi of the factoring scheme will be with some points. First point will be there should be a factoring arrangement between the client and the factor, which is the financing organization. The next one will be whenever the client sells goods to trade customers on credit, he prepares invoices in the usual way. The next point will be the goods are sent to buyers without raising a bill of exchange but accompanied by an invoice. The next point about this modus operandi will be the debt due by the purchaser to the client is assigned to the factor by advising the trade customers to pay the amount due to the client to the factor. And the important point in this will be the client hands over the invoices to the factor under cover of a schedule of offer along with the copies of invoices and receipt delivery challans or copies of ledgers. The factor makes an immediate payment up to 80% of the assigned invoices, and the balance 20% will be paid on realization of the debt under this operandi. Factoring as a source of financing. Factoring is a source of finance for small business. As we know, factoring is a financial transaction between a business owner and a third party who provides instant cash to the former in exchange for the account receivables of the business. We can tell factoring also in some other words, a cash-strapped business which is unable to get this separately needed funds sells off its invoices that are called account receivables to a third party and in exchange gets the much needed cash. Factoring offers the advantage of getting quick cash, secures the debts incurred by the business, reduces the risk of bad debts, and helps to ensure a smooth cash flow. The factor in turn makes money since he buys the account receivables at a discount. Factoring mainly works with three parties. One is the seller, the receivable, and the organization. The seller is a person who is selling the receivable. The receivable is an asset since it is amount owed to the seller for goods sold or services rendered. The third party is an organization interested in buying the receivable at a discount from the seller and pay cash. Factoring has three components in its financial transaction. One is advance, second one is reserve, third one is fee. Advance, this is a certain percentage of the face value of the invoice paid to the seller when he submits them for sale. Reserve, this is the amount that is kept till the debtor makes the invoice payment. Fee, this is the amount charged by the factor as the cost of the transaction and is deducted from the reserve and paid in the end upon receipt from the debtor. The factor takes into account the risk involved in case of non-payment by the debtor and accounts for it while deciding on the amount to give to the seller. Securitized transaction is termed as structured transaction because through specific choices relating to the type and amount of assets in the pool and particular features of the transaction, these securities may be structured to achieve a desired level of risk and a desired level of rating. In a securitized transaction, the burden of repayment of the bond shifts away from the issuer to a pool of assets or to a third party. The cash flows from the pools of assets which have been securitized provide the funds for repayment to the bond. Securitization is a carefully structured process by which a pool of loans and other receivables are packed and sold in the form of asset-backed securities to the investors to raise the required funds from them. Through this process, relatively illiquid assets are converted into securities. Securitization falls under the broad category termed as structured financial transactions. Structured finance refers to securities where the promise to repay the investors is backed by the value of underlying financial asset or the credit support of a third party to the transaction. Mechanism of securitization. The first process is the process of securitization starts with identification by the company the loans or bills receivable in its portfolio to prepare a basket or pool of assets to be securitized. The second step will be the pool of assets so identified is then sold to a specific purpose vehicle, which is called SPV or trust. Usually, an investment banker performs the task of an SPV, which is also called an issuer, as it ultimately issues the securities to investors. Once the assets are acquired by SPV, the same are split into individual shares or securities, which are reimbursed by selling them to investors. These securities are called pay or pass-through certificates, which can be called as PTC also. After that, repayments under the securitized loans or bills keep on being received by the originator and passed on to the SPV. Although a PTC could be with recourse to its originator, the usual practice has been to make it without recourse. Accordingly, a PTC holder takes recourse to the SPV and not the originator for payment to the principal and interest on the PTCs held by him. However, a part of the credit risk as perceived can be absorbed by the originator by transferring the assets at a discount, enabling the SPV to issue the PTCs at a discount to face value. PTC is nothing but it is pass-through certificates. Finally, the debt to be securitized and the PTC pass-through counter issues are got rated by rating agencies on the eve of securitization. The issues by SPV could also be guaranteed by external guarantor institutions to enhance creditability of the issues. The PTCs before maturity are tradable in a secondary market to ensure liquidity for the investors. Utility of securitization. Securitization as a financial instrument is becoming extremely popular in the world over, with more and more issuers resorting to raising funds through this route. This is for the fact that it confers lot of benefits on the parties to the process. Securitization serve as handmaid to organization in raising additional funds to finance their growth program. Companies with poor credit standing and therefore finding it difficult to procure resources from the market can obtain funds by issuing asset-backed securities at lower interest cost due to high credit rating on such securities. Further, cost of raising funds by way of securitization is cheaper than that involved in funding by way of conventional fundraising instruments. It is like shares, bonds, debentures, and commercial papers. Through its novel mechanism of diversifying the risk factors, it's enhancing the credit and removing uncertainties for investors. Structured securitization facilitates the originator to access the securities market at debt rating higher than its overall corporate rating. Securitization in India mainly takes the form of a trust structure, wherein the underlying assets are sold to a trustee company which holds the security in trust for investors. The trustee company in the case is a special purpose vehicle which issues securities in the form of pass-through or pay-through certificates. The trustee is the legal owner of the underlying assets. Investors holding the PTCs are entitled to beneficial interest in the underlying assets held by the trustee.